Wait, before you buy that house this year, you will want to watch this video to see why that might not be the best idea. By the end, you'll have all you need to make the best decision for purchasing a home in 2023. So the first question I'm gonna ask you is, do you really wanna buy a house? Are you sure? Are you really sure? It's like that extra button that shows up on your computer. Are you sure? Do you really wanna buy a house? Yeah, I've heard so many people over the years say like, I just need to get into a house. Well, why? Why do you have to get into a house? What's the American dream? Even though the new American dream's not that, video to come. But is it really the house you really want to buy? Or is it a house you need to buy? Why not rent? Because I'll tell you, from owning a house right now, in fact, while I'm filming this, guess what? Our basement is trash from flooding. And I got to put over 100 grand into that freaking basement to get it back to tip-top shape once again. So that's the kind of stuff that comes with homeownership. You have to be responsible for it, and there's nobody else to pay for it. Where if you rent, that kind of stuff happens, guess who's on the hook? It's the owner, right? Not you, it's the renter. So I really challenge that question is, do you really want to buy a house, and what's the real reason? Do you think it's because you might build equity? And that may not be a bad idea. And trust me, I think buying a house overall is a great strategy. But so many people are ill-prepared to buy a home. They're just not quite ready financially, or, based on how they want to live their life, they would be more free just renting. So I really want you to answer that question honestly and see why you really want to have that house. So really don't rationalize at all. Figure out a way to see what's the real core reason why you want to buy that house. Now, if you do, there's a few things you want to make sure you are prepared for before you try to buy that house. Number one, how is your credit score? Is it high? Is it low? Do you even know what high and low might be? If it's over 700, that's a good credit score, right? If you're below 700, especially if you get below 680, you limit your options and the interest rates go up quite a bit. And so you want to really look at your credit score and see if there's anything on there that, one, is hurting your credit. Two, maybe it's inaccurate. Maybe there's something on your credit that's hurting your credit score that really isn't true. For example, I remember I saw a collection show up on my credit that wasn't there. And it wasn't something I had at all. And so I had to go and dispute that from my credit report. Now here's one way you can find out. Very easy way is you can use things like creditkarma.com. You can generally see what's showing up in your credit report, but I will warn you, the score is not always accurate, especially if you're trying to get a home. So if you want to get a more accurate score and to see exactly what's on there, I would recommend going to websites such as myfico.com. That's myfico.com. If you go there, you can run all three credit bureaus, which is what a bank will look at if you're trying to get a mortgage. Run all three. First, see what the scores are, because they will go for the middle score. So between the three scores, the one that falls in the middle is the one that they accept as your true score. But also check for inaccuracies or things that maybe could be hurting your credit. There's some things that you might see from past collections or past things that may have been there, but maybe you paid them off years ago. Be sure to go on there. You can actually dispute through their site, dispute anything that's creating a negative score. Heck, even if it's true, you can just try to dispute it. Because if those credit card companies or those lenders don't reply back within 45 days, it drops off your credit. So, hey, what's the not try, right? If there's something that's hurting your credit score, go and try to dispute it. So definitely check out your credit score. Now, unbeknownst to a lot of people, your credit score is not the only thing that banks look at for your house. There's really, I call it the big three, right? It's credit score, savings, debt to income ratio. Those are the big three things you need to make sure are really taken care of. So the second one is savings. How much emergency savings do you have? A bank will want to see that you have enough money for the down payment of the house and you have enough money also to make at least 6 to 12 months of monthly payments. So if the house you're looking at is going to have a mortgage payment of say $2,000 a month, you better have at least $12,000 to $24,000 saved up and that's in addition to your down payment. So if your down payment is going to be $30,000 and you need to show savings, you might need to show $50,000 in savings for them to say, okay, good job, check. This is even true if you have an infinite banking account. Like we talk about infinite banking life insurance policies. If you have infinite banking, that does count towards those savings. So be sure not to ignore that if it really comes down to the wire. In fact, whenever I apply for a mortgage, I don't even show them my bank savings anymore. I just show them my whole life policies that have cash value, that's tax-free savings account saved in there. I just send them that and they check it right off and move on to the next thing. So really look at your savings, make sure you've built that up. Many people I've seen that are really desperately trying to get to a house have not done this next step on savings. You need to make sure you've got more than enough saved up, not just for the down payment, but also for reserves. Here's a key tip for you. If this is going to be like your first home, for example, look into FHA options. FHA type of mortgages will allow you to put 3% down on your first home. So look into those options to help save you some more money. All right, and then the third thing, I mentioned that credit score is the big one, then your emergency reserve is second. The third one is your what's called debt to income ratio. Debt to income ratio is simply this. They take your monthly payments that you have on your mortgage, your other mortgages or rent if you're paying rent, car loans, credit cards, student loans, any kind of loans that you have that show up in your credit report, and they take the minimum monthly payments, they tally them all up, and then they compare that to your gross income that you make from your job. So for example, let's just say between all your different debt payments and your rent and everything else, it's $3,000 a month. If you're trying to get a mortgage, they're going to want to make sure that you're probably making pretty darn close to about $10,000 or $11,000 a month in that case. Why? Because they don't want your mortgage to be more than about 28% of your gross income. So if you make $10,000 a month, they don't want your mortgage payment to be much more than $2,800 a month. Does that make sense? So they want it to keep it around 25 to 30% max. Now, total debt, if you look at all the other debts, they don't want that number to really go over roughly about 45%. So again, if you make $10,000 a month, they want your monthly payments, including the mortgage, to stay under about $4,500 a month. If it goes over, they can very easily say no. So the way to get around that is focus on paying down other debts. You might be able to pay down those other debts, freeing up that debt to income ratio, not just allowing them to say yes to the loan, but also giving you the best interest rate you can get. Now, what strategy would you use to pay off debt and which ones? I will tell you, we teach in other videos, we talk about the cash flow index. The cash flow index is simply figuring out what's going to give you your biggest bang for your buck. What's the lowest amount of money you can do to pay down or pay off on a loan to free up the most money per month? So the cash flow index takes the balance of that loan, divides by the monthly payment, and you get a number. So if you have a $10,000 credit card that's $200 a month, that index is 50. But if you have a $10,000 car loan that's $500 a month, that's a 20. The lower the number, the lowest number you want to pay off first. So you want to take that and pay off the car rather than paying off the credit card, because you'll free up $500 a month, which gives you greater ability to get $500 more on a mortgage payment. So you want to focus on that versus just going for the credit card. They don't care about interest rates. They don't even care about the balances of your loans. You could own millions of dollars. The only thing the banks care about is really what you should be caring about, which is how does that affect your month-to-month living, your cash flow, your ability to keep paying on that loan no matter what. That's really what the banks want to look at. They want to see what's your debt payments. This is why I recommend do not go for getting a 10 or a 15-year mortgage. Look at more like a 30-year mortgage. And then if you want to pay extra, pay the 10 or 15-year payment onto that 30-year mortgage. Much easier, much safer, and it's going to allow you to be able to qualify for those loans and get the best rates possible. To give you a little bonus tip here, you can even use this cash flow index in reverse. I had a client who was trying to qualify for a mortgage, but they weren't quite there. And they said, Chris, well, what do we have to do? They said our debt to income ratio was too high. I said, well, tell me, let's look at all of your loans. And we did. And I said, well, how much did they say you're off? Well, they didn't tell us. Okay, go back and ask, how much do you need to free up on your monthly payments to do that? Because the mortgage guy said, you just need to pay off this $7,500 credit card and then you'll qualify. I said, get the exact number you need to pay down or get free up in payments so that you can qualify. The number was only $41 a month. That credit card I was telling them to pay off was actually $76 a month. So what that means is it's a cash flow index of about 100. 7,500 divided by 76 is 100, meaning for every $100 they pay, it frees up $1 a month. So I told them, I said, guys, do not pay off the entire 7,500. Keep some more of that money in hand. Instead, just pay 4,100 of that 7,500 and you'll qualify. They did, freed up the money, and they said, you're approved, and they got the loan. Saved them $3,400 of cash that would have come out of pocket just because they were gonna listen to what the mortgage broker said. It's always about that debt to income ratio. So like I said, those big three are credit score, how much you have in savings for your emergency fund and down payment, as well as your debt to income ratio and figure out what debts you may wanna pay off. But ultimately, it comes down to this. You may want to wait. You might not be financially prepared yet. You might need to do some of these things first before you try to buy a house. Know that there will always be an opportunity to buy a home. Even if you're afraid of inflation and prices and everything, don't worry. Things are going to come back into balance one way or the other. I'm not saying interest rates won't go up. They could go up on you, and that might mean it's more expensive. But it's so much better to do it right. It's so much better to do it going in with peace of mind than trying to desperately qualify, do whatever you can to get into that house, only to have it become a burden to you because you weren't financially ready. So you want to be able to do that. Now, if you're financially doing well off, maybe you're saying, hey, I'm just looking to purchase a home in 2023. Is it the right time or not? I'll just tell you this, I think interest rates will go up some more. This might be the lowest interest rate environment you're going to get. And I've also noticed that buyers are coming back into the market in 2023, meaning you're going to start having more competition. So if you are financially set and you are ready, this right now, the first half of 2023 might be your best time to get in before we get into the summer and the fall when things might start picking up some more. So I could be wrong, but I really think that now is a great time to buy your home if you are financially ready. So guys, that's the key you want to look at. Do you really need this house? And if so, make sure the timing is right and your financial situation is right too. If you like this video, check out our next video. What are the pros and cons of paying cash for a house? Or should you get financing? See my answer here.